morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. The most important event of next week is Fed meeting, which is due on 13th and 14th June. Now let us understand what is the impact of Fed meeting on dollar index and rupee. Before we move there, let us decode what is the market expecting of Fed meeting. If you see the chart, there are two lines which are showing. One is blue line and one is a red line. Blue line is indicating June ka probability and the red line is indicating July ka probability of a rate hike. If you see the chart, the beginning of the month, in the month of May, the probability of June and July rate hike was very, very low. And as and when the US data started coming in, market started thinking that the Fed is going to increase the interest rate in June and July as well. Currently, because of last week data point of job data, market is expecting that the Fed is going to pause in the month of June and they are going to increase in the month of July a 25 basis point rate hike. Now, according to us, there can be four kinds of scenario. Scenario number one, which is the market is expecting, pause in June, hike in July. If that happens, dollar index will move towards 103.50 to 104 kind of a level, and rupee will consolidate between 82.20 on the lower side and 82.50 on the higher side. Second scenario, hike in June and pause in July. Uska probability is also 40%. If that happens, dollar index will immediately shoot towards 104 to 105 kind of level, but it will short lift there because again the dollar index is going to come down. Similarly, rupee will also get weaker towards 82.65 and 70. Then again it will enter into a consolidation phase. Now let us understand what is the third scenario. Third scenario, they say pause in June, pause in July. If that happens, dollar index will crash down and it will move towards 102 or 101 kind of a level. Rupee will get stronger and it can move towards 81.80 to 82. Although मैंने 10% probability लिखा है, I don't think that event can happen. And the last scenario is hike in June and hike in July, which is technically saying very, very hawkish kind of a comment from the Fed side. In that scenario, dollar index will shoot up drastically towards 105, 150 kind of a level, and rupee can get weaker towards 80 to 83 kind of a scenario. Now, if you see the chart with respect to rupee, there is an 80% probability that rupee is going to stay in a range between 80 to 20 on the lower side, 80 to 80, 83 on the higher side. Let us discuss outlook for rupee. Market can move in three phases: upward direction, downward direction, or in a consolidation phase. Currently, the market is moving in a consolidation phase, and there is an 80% probability that for the coming week, we expect the market to move in a consolidation phase between 82 on the lower side and 82.70 on the higher side. Any dips towards 82 to 82.20 should be used by an importer to hedge their imports, and any level close to 82.70 should be used by exporter to increase their hedge ratio. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporter. From last couple of weeks, we have been suggesting them that ideal strategy for any kind of thin margin exporter is that they should cover 100% on a back-to-back basis, because 82.75 to 82.80 was acting as a strong resistance for the pair, and currently also it is going to act as a strong resistance for the pair. So ideal strategy for them is to continue to hedge 100% on a back-to-back basis. 82.50 to 82.70 remains a good selling zone. If anyone is waiting, they should keep a strict stop loss of 82.20. Now let us discuss strategy for thick margin exporters like textile exporter or an engineering exporter. The easiest time to make money for thick margin exporter is when the pair is trading in a range. Book forward at the higher end of the range and utilize forward when the pair is trading in the lower range of the pair. Currently, if anyone wants to book, they should book between 80 to 50 to 80 to 70 kind of a level. And when the pair comes near 81.80 to 82, they should pre-utilize the forward. Idle hedge ratio, if you are booking against confirm order, is between 60 to 70%. If you are booking against anticipation, then the idle hedge ratio has to be less than 50%.
Very good.
Now let us discuss strategy for importers. Keeping it very, very simple. Keep a stop loss of 82.80 and wait for lower levels of 82 and 82.20 to cover 1 month import. With this, I will end my today's presentation. Jai Hind. Namaskar. फिर मिलेंगे next week. Thank you.